Celeste. How are you?
Good, good. Hey, Guy Cohen, can you hear us? I hear Guy is stuck in traffic.
Hi guys. My lunch meeting, which I could not refuse, turned up an hour late, and London then becomes instead of an hour back home, 2 hours back home. So that's my situation. So I'm flying blind with you guys today, but I'll describe as much as I can to paint the picture of what I wanted to say.
Well, that will be great. I'm sure you're painting.
And I'll go on mute when I'm not talking.
Yeah, that will be great. Though I'm sure we'll be able to visualize a lot of what's going on there with you. So, Guy, thanks for joining us even in the midst of everything. So, well, let's go ahead and get started, everyone. It is 12 o'clock, and hey, did y'all listen to the meeting this past week with Jerome Powell and markets went?
Didn't hear a word of it.
And here, good, good, good. Did you listen to it, Scott?
Well, I didn't listen to it, but I read about it, and I saw what the market thought about it, and I saw the nuttiness that resulted. So yes,
exactly. Hey, Guy, can you chime in? What did you think about it from across the pond?
I got the gist of it. The thing is that we've been bullish since pretty very close to where we were oversold in October anyway. So if you go back and see my blogs, you'll see when we turned. Because market timing is one of the things we're pretty good at. Celeste, you should know that if you're following me every day or every week rather. Yeah. But it's kind of, we are so extended right now, and my basic message is going to be don't chase. It's like fellas, you know how chasing women too hard, it doesn't do much good. It's kind of a bit like that. It's don't chase an overextended situation. There's no good that can come from it. Although I think there's probably a little bit more juice in this. It's you don't want to chase already overextended issues. You better off being patient for the next retracement.
It is definitely overextended. Yeah. And I'd say a lot of, following, when you follow the Trading Pub and Prosperity Pub and DTI and Guy, everything, that's why we have these experts come on week after week, because all of them, all of you guys just nail turns and twists in the market over and over again. And we're just trying to get out of our heads into this platform here with Ask the Pros. What's going on in our heads as traders into your heads, hopefully, that can help you get on that right side. So thank you for all of you guys who contribute to that. Well, first of all, I got to tell everybody that there's risk in the market. And just in case you didn't know that, it's very real. Even when we're up here at the tops, it feels, maybe you feel good because you rode to the top, or maybe you're feeling like you were left behind. It doesn't really matter. There's always risk in the market, and you need to be aware of it. And you need to understand, to the best of your ability, what's going on, because your money is at risk, and you can lose your money, and you can lose a lot of it. And we don't want you to do that. We want to help control that for you, with you, and kind of give you those ideas that we're doing along the way. So with that, let's really get started. And Scott, let's start with you. What are your thoughts, in the broad markets after, we're reaching all these highs? By the way, too, we have triple witching day, options expiration day today. So that can also contribute to any gyrations for today. But what are your thoughts about the broad market after the FOMC announcement going forward? Just in general, what do you think, Scott?
Well, yeah, I agree with everyone saying it's overbought. But I guess the thing I'll never forget is 2020 in March and April. There's never been a time in my trading life where things were more overbought right after it did that V-shaped bounce right off the bottom. I mean, it would have been absolutely ridiculous to buy. And then, of course, it went a bunch of other months, right? And it went maybe for the rest of the year, really, but went so hard for many, many months. So overbought is tricky. And I think it's tricky if you don't have your system and you don't know exactly what you're doing. Because overbought feels like, if you're a discretionary trader, it feels like, I kind of want to get in Apple. Oh, wait, Apple went up today. Well, then I'll wait till tomorrow. Well, then it went up again. Well, wait, I'll wait. And then we went up again. And all of a sudden now, it's just as Guy said, we're chasing. And in the discretionary overbought situation, it means your stuff is going up. And you might be buying it near a high. But usually that means in a discretionary situation. So all you can do in that situation is, if you're not sure, don't do it. Just wait. Of course, the market is not going to go up forever. But at the same time, if you have a strategy and rules, then all you got to do is follow the rules. And overbought doesn't mean anything because overbought is already baked into your strategy, right? So, let's talk some long only traders don't trade in 2008 and 2020 when things are going down, like it's below their moving average or whatever it is. So they're just not trading. They don't worry about overbought, oversold. They worry about, are my rules being followed right now? So yes, it's overbought, but if I get a long signal, that's not a maybe a should or a FOMO based signal. It doesn't really matter if you're a system trader, and if you're a discretionary trader, then it's fine to just wait.
Yeah. Great. Good answers. Good answers. All right. What are your thoughts, Jack Carter?
I love the market that we're in, Celeste. I really do. And speaking of overbought, that you got to watch out when you think something's overbought. I'll give you an example. Take a look at AVGO this week. And this is a stock I own. I'm not telling people to go out and buy it. It's also a stock that I use to create a lot of income trades, credit spreads, that kind of thing. And it's just been great. But the thing about it is that stock was kind of beat up last week. And this week, just when you think it can't go higher, it goes higher. If you look at the chart every day this week, it's been going up. It's probably even up today. It's the most craziest situation I've seen with an overbought stock. And I like that stuff. You get a lot of people caught short when you're talking about overbought stocks, and they can really heat up. The broad market, I don't think is overbought. Maybe the Magnificent Seven, but there's a lot of stuff that hasn't even really moved this year. And again, it really doesn't matter to me. I never once in my life looked at a stock that was oversold, and I never once backed off of a stock that everybody said was overbought. So that really doesn't apply to me. I like the volatility, but I don't look at the market in terms of overbought or oversold.
Excellent. Really good. Really great comments. We could just almost end the whole session here today and go back and listen to the recording. Everybody, I mean, a lot of words of wisdom shared right there. Thank you. Well, let's keep it going. And yes, here says volatility is a key, and it's best, especially for the shorter term trader, right? Where you get all the moves and understanding how to work with that. Well, let's keep it going. And Guy, let's move over to you and tell us a little bit more about, the valuation of the market and where the opportunities are. And tell us a little bit more, because I know that you look particularly at options, and you have a really great indicator with the options strategies, and, with the volume increasing in all the options, spill the beans, what do we need to look at now?
Sure. Well, first of all, I was getting very hurt by the fact you said everyone could pack up, but before I'd even spoken. So that was really it's like I was really getting a real. My ego was getting really punctured then. But anyway, no. If you've got a chart open, anyone, have a look at take the SPY for example, and you'll see the high in July, and you'll see that it made one move, big move down, and I can't remember when it popped up again, then made another big move down into October. And one of the things that we're really good at is market timing. In fact, I forgot, Celeste, I think all of your crew get our market timing, at least they have been getting it every week anyway, because we post it out to you guys. So what I want you to think about is market structure here. So you've had two moves down from the S&P, and most stocks as well, especially high beta stocks have done the same, from the high in July down to the low in October. And since that low in October, we've just been steaming up, and it has been a meaningful move. And you could argue that you've been overbought. I agree. Actually, Jack makes a good point, because you can be overbought for quite some time. So Scott said a similar thing as well. And you can be. We've actually been overbought for quite some time, but it didn't matter. We still had room to run. Now, what we look at now is, in this situation where you're getting near the end of the year, and there's going to be some kind of profit taking at some point, maybe for tax purposes or whatever. There's going to be some logical reasons for things to calm down imminently. The question is, what happens next? And what is likely to happen, I'm just going to put it out there, and then we can see what happens over the next few months. But what I think is very likely to happen is that we'll find a high pretty soon. And then we will retrace down probably at least to the 50-day. on the index, and many, highly liquid and high beta stocks as well. Because what I'm expecting in terms of market shape is for this next retracement in the market to be of a lesser degree than the other two we had since July. And what that will then set you up for, if you have missed the boat, what I think that will set you up for in 2024 is a really decent bullish situation, because moves like this tend to be the precursor for something more to come. And that's what I anticipate as I see it now. Now, this can change, from week to week if there's a big piece of socioeconomic news or geopolitical news comes out to change our minds. But this is what we've been saying for some time. It hasn't happened yet. We haven't had the big reversal yet. But when it does happen, and it will happen, you will get a retracement back down to a key level like the 50, and it'll be of a lesser proportion than the ones we've had since July. That's why I'm putting it out there, just because I think it's kind of fun to put your neck on the line, and then people can see, whether you're a hero or a goat, as they put it in American language. That was from The Natural, by the way, that great movie with Robert Redford. But anyway, you're a hero or a goat. But anyway, that's what I anticipate to happen. Now, in terms of options transaction data, which again, we specialize in, and by the way, we do not deal in unusual options data, because that's mainly daily churn anyway. We deal in what's more likely to be position building. Again, we've been bullish since the lows in October, and it still looks cooked at that in that from that perspective. But where the hesitation comes from our point of view is that we are so far extended away from those natural key levels like the 200 and like the 50-day moving average, that it's difficult to try and enter stocks in their trend when they're that far away from those key levels. And one of the reasons I say that is because I like to buy stocks consolidating just above those key levels when I've got other, what we call big money footprints in play. Because what we're looking for is for indications of accumulation. And you're not going to get indications of accumulation from one indicator. You need to build a picture. So we look at volume behavior, we look at price behavior, we look at key levels behavior, we look at options behavior via the OBI. We look at shrinking retracements. It is a setup that I just described to you, where downward moves are shrinking in terms of their extent. And we look for consolidations as well in those contexts, which could also be a big money footprint if they're consolidating price and volume together. So we look for a picture, and what that picture appears to do, and I can't prove it, but it's the logic behind it, is we look for evidence of impending accumulation or existing accumulation at safe levels where you're not overbought. And you can do it the other way around for bearish as well. So that's what I wanted to describe to you, what we look for in a chart. It makes complete sense. It's entirely logical. It's backed up by stats. And so that's that. And that's why if stocks are way overextended, no matter how good they are, it's really difficult for me with my strategy. And Scott alluded to this. In fact, he didn't allude to it, he said it specifically. If you have a strategy, stick with it. Well, that's our strategy. And so moving forward, if we've missed the boat, or you could have, been involved a little bit more actively, don't worry, it's all right. Our time will come again. And when that time that will come again will be once we've retraced back to a key level, and then things won't be overbought again. But I'm pretty confident as I look at the market right now, I'm not a long-term predictor, that retracement will be the precursor to another up move in due course, once it's happened, and hopefully it forms a nice sort of base or consolidation there. But then you'll be able to see market structure. And then also, not only will you be able to see that, but hopefully I'll be on with you guys and I'll be able to show you exactly what's happening to the point where we can enter or re-enter again at safe levels. So that's just for the people who've missed out. For the people who haven't missed out, who are riding this trend, just make sure to raise your stop gains, so that if you do have a big retracement, you can either get out or exit half part of your position. But don't allow profits to turn into losses. It's one of the key elements of our trade plan, and it's one of the key pieces that people lose the most when they've had a position, it got into a profit, but they thought it would get a bit more. They maybe didn't ring fence their risk, and then a profit turned into a loss. So that's kind of my thing for today. If you miss the boat, don't worry, this boat will come around again.
That's for sure. That's for sure. So that's well said. Hey, Guy, I know I'm trying to share a screen just showing the S&P. Actually, it's S&P futures. Just kind of going along with what you were saying, trying to help folks with that. But, and one of the things that you mentioned is that you like that consolidation kind of period above, at key levels. And I was just wondering, what were your thoughts then, as that S&P was really looking to me like, really consolidating there the end of the month, the beginning of December, end of November, beginning.
Loved it. We called IWM last weekend, and I've already got people. And the great thing about, if you are going to ever trade, by the way, I'm just arriving home now, but if you ever trade, if you trade, ETFs like IWM or SPY, etc., the great thing about them is they are uber liquid, but even better than that is their options have very low implied volatility, means they have very high leverage multiples, even if you go deep in the money. So you can literally go 70 or 80 deltas, you'll still get the liquidity, and you'll get lots of leverage as well, and you won't have any time decay risk, which is the way we like to do it. And the IWM, and even with about an 80 delta, deep in the money, 3-4 month option, you're still getting a leverage multiple of around 6, maybe even 7. And that will only increase as you're in profit. And obviously this week, loads of people are being very happy about what we said about IWM. So one thing I would say, guys, is that while volatile stocks can look spectacular, you can look at the less volatile issues and trade very liquid, deep in the money options with them, and get a much better return profile without the risk of being whipsawed left, right, and center as well. So frankly, I would rather do something with a stock like Apple, which I know has got all the liquidity I could ever want, even with deep in the money options. But I know that Apple, notwithstanding earnings or something like that, is not going to be gapping and doing crazy things when it's behaving very technically. So, you might look at an upstart and think, oh, that's great because it can double in a month. But you can do great things with much more conservative stocks, with very liquid options, with very low implied vols, and therefore high leverage multiples. And you can make money much safer that way. So do think about that. And they behave much more predictably as well around those key levels, with a much more reliable OVI signal. In our case, we use OVI, etc. So, don't think that you're missing out just because some crazy stock has done some crazy behavior. There's usually, even Amex, we've done incredibly well both ways with Amex this year, short and then long. Don't discount these stocks because they're really, really good. They behave predictably. And then you can just soup it up with some very conservative leverage, which will do way better than trying to deal with whipsawing, gapping, crazy stocks.
Guy, I got to ask you a quick question. When you're talking about these deep in the money or deep out of the money options, are you buying them or selling them?
No, I buy deep in the money options. No, I know, Jack, you're a credit spread guy. I know you really major on that one. I'm not a specialist in credit spreads. I like upside. If I see upside, and this is, by the way, there's no right and wrong in any of this, guys. Everyone's got their style. I've got members who are just like you. They just only want to do credit spreads, and that's great. If they're good at it, stick with what you're good at. We can't all be a batter. We can't all be a pitcher. But the philosophy that I've had, and this is just the journey that I've taken, the research that I've undertaken as well, is that we have a philosophy of looking to identify accumulation from a number of metrics, of which several are our own, proprietary metrics, and it just works really well. And that's what works for us. But of course, once you develop your own system and your own style, your own metrics, your own algorithms, you are more attached to them because you've worked with them for a long time, and you can't expect everyone to gravitate to that. So there are many ways to skin the cat in trading. Yes. This is just the particular journey that I have taken, but there are just as many people who would prefer to do credit spreads, and I know a bunch of them too. So, I'm laid back. Well, all I would, and by the way, my philosophy on the way we do things works really well with credit spreads as well, actually, because stock starts to bounce out of a key level. You can do the credit spread on the other side, and guess what? you can literally get out with 80% of your profit in 2 days, and happy days. I know you like to stay in it, Jack. We've had this conversation before, but whatever your style is, it doesn't. You've got to do what suits you. Whatever
Right.
your whatever your as a trader, whatever your sorry, I'm moving my car now again. Whatever your, not just style, but whatever your routine is. Routine is really important in a trader's existence, because one person may have half an hour a day to do their stuff, and another person might have 4 hours to do their stuff, and so that plays a part in the strategy and the effort and the time you can put into this stuff as
Yeah,
well.
it certainly does. All that, the amount of time that a trader has and the desires, everything. So that's really well put. And let's keep the strategies and the routines going. Let's find out some more. And just real quick, Jack, I'll go to you, and then to you, Scott. Just what are any final thoughts there on those comments, Jack? And then we'll go to, I want to hear about
On
value with Scott.
on the comments that that the
Guy.
guy made. Yeah. Well, I'm glad that works for him, but I don't have he's, I'm the Homer Simpson of the trading community. I cannot wait for a pullback. That makes no sense to me. I like to jump on an already moving train, right? So I don't want a consolidation. I don't want to wait around. I want to buy high and sell higher. That's my thing right there. A lot of people say buy low, sell high, wait for a consolidation, pullbacks, all that kind of stuff. That's fine, but I just don't like waiting. And every single day, I can find a stock that's about to move higher, one that's already been trending higher. So that's the way I approach it. When I look for a stock to get into, I don't want to look for something I'm going to get into next week or 2 weeks. I want to get in now. And I'm then either going to buy that for a directional trade or use that stock as an asset to create an income trade, whether that's a naked put, credit spread, cover call, whatever. That's how I go about doing it. And again, that just goes back to what Guy said. You have to find. Obviously, he's a lot smarter than I am. I just like to make it simple. I wouldn't know a consolidation if I saw it. So I just like to see something that's already going. Jump on, buy high, sell higher, jump on that already moving train. And a lot of that starts with stocks making a new 52-week high, which I'll talk about a little bit later today.
Excellent. Can't wait to hear about that. And just like Sarah says, find out what works for you. Well said, Sarah. Thank you. All right, let's find out what's working for Scott. What are you looking at? Talk to us about some value. Even, Jack, you were already talking about everything moving up and down, and there's a lot of other stocks that haven't even really taken off yet. So let's find out about that. Take over the screen and share with us, Scott.
All right. Taking over, hitting slideshow. And from the beginning, and how does that look?
It looks awesome.
Okay, well, I mean, both those guys said something great as usual. But for me, so many times it comes back to tennis, and there's more than one way to win a match, right? And there's more than one way to trade. And the comment that we got, it was absolutely right. You have to do what you like. You have to do what sits well with you. You don't fit your trading style. You don't fit your lifestyle to your trading. You fit your trading to your lifestyle. You have to do what you like. I've been on before, and I like a couple things, as sometimes traders do, but I like breakouts, just like Jack said. I love them very much. We've talked about long-term breakouts on even weekly and monthly charts where the price is already moving and we just buy it. Nothing wrong with that. I absolutely adore that. But that's not what we're talking about today. We're going to all the way the other end of the spectrum. And I guess the hope is between one of those styles, something really fits with you who's watching, and then that's the one that will make you a bunch of money. All right, I'm going to, again, caution you, don't risk any money you cannot afford to lose. These numbers are for education purposes, but we try to make them as accurately as possible. By the way, if you want, I do some writing. People have asked before. There are the links. Who cares about that now?
Scott, we're not seeing maybe the rotation of the screens. We're still on the very first one.
Really?
Kind of in a preview mode. Yes.
Ah, well then we can't have that now, can we?
Maybe it's
let's see. Escape. Screen sharing. Huh.
yeah, still went back to, so we're just, I see your cursor getting ready to click. Maybe there you clicked on the next slide, the disclaimer. So we see that now.
Yeah. Can I leave it like that, or do you want me to make a big screen?
Go for it.
Just
Leave it that way is good. Yeah, we're good. Yeah, there we go.
Okay.
There, that's what I wanted everybody to see.
Okay,
Yeah,
gotcha.
where you can all get that from Scott.
Okay. Yep. Let's get into, first of all, this is very Warren Buffett-ish.
Mhm.
And I talked about it last time I was on in October. Warren Buffett always said, what's rule number one? Don't lose money. Rule number two, don't lose. See, rule number one, don't lose money. But I never really understood that, because every trading system loses money, every trading system. So what does it mean? Well, as I talked about last time, it means buying something with a huge margin of safety and then holding on, not necessarily having a tight stop loss. And that's the style we're talking about today. Now, here are some real life examples, but we're taking Warren Buffett's ideas and putting them into something that we can actually get our teeth on. This is my favorite, the 800 period simple moving average. Okay. To me, I've done so much work on discounted cash flows and fundamental analysis, and I've decided that I like the 800 simple moving average better. It is my fair value price. And here is an interesting, again, for people who haven't seen this, Coca-Cola is one of Buffett's biggest stocks, right? Back in 1988 and 1989, Coca-Cola was slightly below, but right around the 800 period simple moving average, which I will call fair value, quote unquote. He bought it. This was an actual buy when Buffett bought it. And what has happened since? Well, it's all the way down here is where he bought it, and it's all the way up there. Right? So buying at fair value, of course, and holding it can kind of pay off. It can pay off, especially if you take big positions. Another one, Apple, which is now, I think, over 50% of Buffett's portfolio. It dipped slightly below fair value back in 2016. And of course, then it's gone up. That was his buy point, and it's just gone crazy since then. So that's the idea. But we're going to talk about that. That's buying a good company at a fair price. We're going to get even more extreme. Hey, back in October, I shared this with everybody, but we didn't know what would happen, right? This is back in October 20th, okay? And this was Goldman Sachs came out with an article, Business Insider, I believe. This is their top 40, right? Most stocks on sale, I guess. Best deep value, Moderna, SEDG, and so forth, right? Oh, and it was back in early October. And I thought that was kind of interesting. That's fun. Now, let's take a look at what's happened since. Oops, let me get back to here. Share, okay. This is the projected return, and this is what's actually happened. You can still see me, right, Celeste? We're still good?
Yeah.
Okay. Moderna's still had some problems. SEDG is a solar stock, still struggling, but some have started to come around. Now, I said it was the Goldman Sachs top 40 with at least 100% upside-ish. All 40 are up 14.47. So not too bad, Goldman Sachs, right? Some of them have not done great, like I said, but some of them are doing quite well. But I took that particular list and I made it my own with the 800 period simple moving average. And I took the top 10 of that Goldman Sachs list. I compared it to my fair value, the 800 period simple moving average. And this was my projected return based on numbers that I don't know how Goldman does their research, so I did my own. Here's how they perform, just the top 10. And you can see that it's made a little bit of money, right? Now, what can we do going forward? Well, first, if I can teach you very quickly how to look at these for yourself, here's DG. Going back to DG is up 22% since we talked about it. Well, here is DG. There's the 800 period simple moving average. I put a Bollinger Band on it, 2 and -2. If this is fair value and price is below fair value, and we're long-term traders without tight stops, if you are, don't have to be, we have some room here, right? And back in October, it was even below. It was way below the bands. Fair value was way up here, and it was way down here. And you can see we've got, what, 22%? And we still have a ways to go back up to fair value. There's still a bunch of room. Had we gotten in here, any place in here would have gotten us some decent wins. So buying stuff at 50% off in this case, or way more than 50% off, worked out pretty well. Target back in October, right? Target had all sorts of troubles. There's fair value way up there in the 180s. It was down at the Bollinger Band in the 90s. And look what's happened since, right? It's gone a little bit bullish. Again, fair value is still above. There's still room on this, even though the market is quote unquote oversold or overbought. I mean, is there still room? And here's SEDG, just gotten killed. 2 huge gap down. The news is terrible. Solar stocks are struggling. It's now way below the band. Fair value is way above. Is there any gains between now and then with this being your target? I mean, kind of looks like it to me. Here's the interesting, back in October, this was October 20th. It was on my slideshow, so we talked about it. Financial stock, it was down below the Bollinger Band. Fast forward, yikes, right? It's on its way back up to fair value. Not very interesting. This is stock that Celeste and I have talked about, MPW. It reached the Bollinger Band back in July. It went below the Bollinger Band in October when we talked about it. It's gotten worse since then, right? Or actually, that was October 22, excuse me. And this was October 2023. And it's starting to stabilize and it's starting to rise. And look at fair value way up here. It's in the 4s, or actually in the 5s, and fair value is at 15. Is there any gain between now and the time it reaches fair value? I mean, maybe, right? And then here, I'll finish up with, these are 2 scans that I just wrote, very simple scans. I built them on 1016. All we're doing is looking for stocks way below fair value, like I just showed. It was Arrow, blah, blah, and we've had some big winners, big turns. You can see that this portfolio is up over 20%. Projected returns still have a ways to go, but like Arrow, for example, AROW just jumped. And then I did one more scan. That was on my TradeStation. I ran it on Thinkorswim. I built this one. Similar rules, again, way below fair value. And that's up over 24% since I ran it in October with all those actual returns. So again, there's more than one way to win a match. There's more than one way to trade. But I love deep value. You can find stuff that's way below fair value. You're not going to get it perfect, right? Not every entry is going to be perfect. But it's that margin of safety that Ben Graham and Warren Buffett and Charlie Munger have been talking about. Here's a numerical way. You take the 800 period simple moving average, you put some bands on, and then you judge for yourself and see if you can make it back to fair value.
Excellent. Really great content. Thanks for sharing all that. Can you go back to the slide that has your contact information on that? Some people were asking for that and they didn't get a chance to really capture that. And even if you want to like copy and paste that and put it into the chat, that would be great. And a lot of people are asking about this 800 simple moving average thing too, and how you're banding that. Is that what you're doing? So I'll let him copy and paste and put that in the chat to everyone. And then just kind of go back, if you don't mind, Scott, and answer that question about a little bit more about that 800, which that's a big number, isn't it? Simple moving average.
Yeah, and I've mentioned it before, but I like to take regular indicators and multiply it by a multiple, by 4, by 5, just so you're looking at a different perspective. And as it's turned out, I didn't make up the idea for 800 simple moving average, but it's really worked as a nice proxy. You put a Bollinger Band on your chart and just set the length to 800.
Nice.
And then the bands just show up, right? So you have the 800 simple moving average in the middle and you have your Bollinger Band, and then you have the up and down 2 and -2. So
excellent. Very, very nice. All right, everybody, recording at atptraders.com, and copy paste that contact information into the chat there too, Scott, if you get a chance. So let's keep it going. Jack, you got me really interested. There's a couple of things why you've got me really interested. One is I know you're a very active person. You do an awful lot of things and you go a lot of different places. So when you say that, you don't have time to wait for this or time for that, like you're going to go boom, boom, boom. And so I love that action. And I want to know how you can stay active, in a market like this at these 52-week highs when a lot of people are feeling, oh no, I can't do that now. I've missed it.
Yeah.
I've got to wait. What do you do? How do you minimize risk and take advantage of all this? Spill the beans.
Yeah. Okay. I'll spill the beans. I got to give you a little backstory first. Back in 1999, I took $25,000, made a public challenge, put it into an account at Schwab, traded 2 or 3 times a week, and ended up with that CPA report. I took all those confirms down to the CPA. He showed the compilation report. I was up like 286%. But, sometimes you're good. You don't know why you're good. So I took all these confirms. That was back when they used to mail the confirmation of the trade to you. I spread them out all over the dining room table and the pool table, everything. And I'm looking at these trades and trying to find out what it is that the good ones had in common, the big, big, big trades. And I was doing something I didn't know I was doing. I was having most of my success with stocks that had just hit a new 52-week high. So I did some research on that. I had a guy back test that 6,000 times, and it showed that like 97% of the time, once a stock hits a 52-week high, it goes higher. Now that could be a penny, and then it goes down, or it could be $10. But for me, I can't do the analysis like these guys do. And that just shows you that's what makes a market when you have three totally different approaches on it. And one thing is, I'm an impatient person. And when I want to make money, I want to make it now. I don't want to wait and have a watch list, because what if nothing's happening, next week on your watch list, and you're going to make another watch list and more waiting. And maybe some guys can do that. I just cannot do that. So when I want to make a trade like today, I'm going to start off looking at a stock that hit a 52-week high, but that's not the whole thing. And a lot of people take that out of context when I teach this, but it has to do that. It has to be a stock that trades on a major exchange. No penny stocks. I don't do crypto. I don't do penny stocks. I don't do foreign stocks. It's got to trade on a major exchange here. It's got to be over 15 or even now $25 a share for me. I haven't done well with the lower price stuff. It's got to trade 500,000 shares of average daily volume a day. It's got to have options, and it should have a beta over 1. And just so people know, a beta is of 1 is what the broad market, how volatile the broad market is. A broad market like SPY has a beta of 1. So any stock that has a beta over 1 is more volatile than the broad market. And I want that too, because ideally I want to pick up $2 to $10 in a 2 to 10 day time frame. And if it keeps running after that, I'll hang on to it. But if it doesn't get out of the gate, I just sell it. Usually I like to put a stop about 7% below my purchase price, but I'll just throw that stop out the window. And if the stock hasn't moved in 2 or 3 days, I bail and look for another one, because I want that to be moving higher. I want to buy high and sell high, because when I used to do the fundamental analysis, that was just a lot of reading, and when you're doing fundamental analysis, that's predictive. And that I don't like that. When you're using technical analysis only, that's reactive. And that's what I love about it. So what I do is, when I see a stock making a new high that fit all that other criteria, and it's been in a trend for 3 to 6 months, then I just want to jump on that already moving train. I don't want to wait. I don't want to find fair value. That stuff is way too hard for me. Remember, I got like a 4th grade education here, so I'm just going to make it as simple as possible. I want to jump on an already moving train. And when I see that chart in a nice 45-degree angle, and I see that stock that is bouncing, one time I'll show you the way I set up the trade with my charts. It's just so easy to get. It's so easy to just buy it at the market, set the stop, and let it go. And that's worked out really, really well for me. That's worked out personally better for me than any kind of consolidation or using too much technical analysis or waiting for a pullback. I know that stuff works for people, but it doesn't work for me. What does work for me is just that concept of buy high, sell higher. So when I see stuff that's overbought, again, like AVGO, man, that's fire. That's real fire when a stock is moving like that. And once a stock hits a new 52-week high, there's technically what's called a lack of overhead supply. And that just can act as fuel for the fire to push a stock even further. And that's what's happened with AVGO. Every day this week, people say it can't go higher. It goes higher. It can't go higher. They start to short it around $1,000, right? The next thing you know, the stock's at $1,100. So then they got to cover their short. That pushes it up even higher. That's the kind of action that I like, either as a directional stock trade or to use that stock as an asset for an income trade, like a covered call, naked put, credit spread, that kind of thing. And that's it in a nutshell. But if you have a second, I have a Christmas surprise for everybody.
Is this going to be your gravy recipe?
This is not going to be, I don't actually have the gravy recipe. I just have the gravy technique.
Okay.
Right. I'm not that much of a cook, but I'm a good gravy eater. So, and I got to tell you about the gravy. The gravy is the dinner. Everything else is a condiment. The turkey, the mashed potatoes. I don't want to get going on my gravy thing, but all right, I got I got an even better
It
thing
was
for
so
you than
fun.
gravy.
Okay.
And what I'm going to talk about here, just real short, is hacking the options market with directional income. And this all is a takeoff of what I just explained is my trading style. So before we go, I want to give everyone here a little Christmas present. And if you know anything about me, you probably think of me as the income guy. That's my thing. I trade for income. And I'm obsessed with income trades because they're just simply, to me, the best way to build consistent success over a lifetime of trading. That's how I got a 97.1 success rate with my credit spreads. And to me, that's the only way. But when people hear income trades, they usually get the wrong idea right off the bat. They think of it as boring, slow moving, and high risk. And those are the terms I hear tossed around all the time. But to be blunt, they're not true. That's just absolute BS, especially in markets like this. And I'm sure you noticed that the market has been ripping like crazy lately. I mean, really. And when it's in a market like this, a relentless trend like this will happen. And I turn to what I think is one of the most underused hacks in the options market. Now, everybody, when they think about options, they think about buying options. But what I do is I call this directional income. And it's a method for using the trend of the market or particularly an individual stock to our favor. So, in order to place income trades that are more aggressive, faster moving, still insured against massive losses with a built in hedge, these kind of trades are capable of targeting 20 to 30%, even a whole lot more. We've had just some monster trades. And in a matter of days, this happens, not weeks. So, my big trade for the week I put on Tuesday for Friday's expiration. So, it's just 3 days. And with all the other great advantages income trading gives you, and right now the market is ripe for these kinds of trades. I'll give you just a quick fact about this. So we've seen options trading volume, and I'm sure everybody's seen it. It's at a new high this year. We're probably have done already twice as much as total options trading in 2022, maybe 3 times what was done in 2021. And what's happening, mom and pop traders have gravitated to buying options. And institutions and hedge funds are also now buying options calls more than they're buying individual stocks. And those two forces have pushed options premiums to the highest I've ever seen them. And when you add in some volatility, you got some juicy, juicy premium. My mouth is watering right now as we speak when I think about some of the returns we're going to make on this. And it's as ripe as it has been in years. So I can't think of a better time to start teaching everybody here exactly how to start using directional income to your advantage. And that's why I'm hosting a live class this Monday, December 18th at 11 a.m. I'm going to spill the beans. I'm going to walk you through it step by step. So bring a pen and paper. And when I teach you everything you need to know to start using directional income trades right away, you'll be able to start on Monday. And here's the Christmas gift part of it. Okay, is normally I wouldn't even charge 99. It'd be more like $1,000 for this class.
For sure.
And even though I believe the value could be 10 times that amount, we're going to do something crazy. We're just going to do for my Ask the Pros audience only. This is only going to be a $9 charge. That's a 90% discount. So if you want to join me on Monday at 11 for my directional income masterclass, which is something I think you're really going to love because it's real simple, it's highly effective, and it's something you could do forever. So you'll be able to get on this class and keep the recording. If you want to get in on this, which I highly recommend you do, it's going to be live. I'm going to be answering all your questions when we get done with it. We may even find a couple of stocks together on Monday.
Nice.
But here's the thing. Go to jackcartertrading.com/class or have your credit card ready and call our team at 308-258-5872 to join me on Monday. That'll be the best $9 you ever spent.
Ooh, perfect timing. Wow. I can't believe you're selling it for that small
I
price.
can't either. That's my publisher for you. He wants
know, I tell you
everybody in. He really wants this to be a Christmas gift, and I think you're going to find more value in this class for $9 than anything else out there. So this also is perfect for what's going to happen next year. People are going to be shocked what happens next year. You know, this year, all the analysts have been wrong numerous times this year. And I think we're going to have a wild ride in 2024, possible interest rate cuts, maybe an interest rate hike.
Yep.
It's just going to be, I can't wait for 2024. This year was okay, you know, but next year and we did great this year. We killed it this year, but it just wasn't as fun and easy. It was a little more work this year. Next year, I can't wait. What's setting up right now is awesome where the market's at. So join me Monday. You'll learn a lot and you might even profit from it.
Yeah. Oh yeah, Jack, I'm so excited you're bringing this. I mean, this is perfect timing. I don't know if you like had a crystal ball and knew the markets were going to be up at these highs, and then presenting this, but that is such a timely gift for everybody. The link is right there. It's been dropped in the chat. All you have to do is click it and get involved that class. Now, Jack, if for a chance, like if they can't make it, or even if they want to listen to it again, is it recorded?
Yeah, we're going to record it and we're going to give a recording to everybody. And it's a good resource to fall back on because I want you to bring a pen and paper. This is no joke. When I go through the class, it's a little bit fast, but I give it to you step by step, exactly the way Homer Simpson would want to be taught. So you're going to love it. It's real simple, folks, but it's powerfully effective. And it's exactly the way you want to go into 2024.
Oh, I love it. I love it. And some people were asking, like, you know, because you were talking about some of the rules and some of the ways you trade these things. And they were like, you know, it's too fast for them to write it all down. Will you be going over those same types of rules again?
Yes, I will. I'm going to give you the big overview, and then each slide we're going to go step by step, you know, just it'll be live initially. Yes, Donna, it'll be live. And I like to do it live because it just it's more relevant when you can ask questions live in a chat as opposed to just watching a video. So yeah, it's going to be good. Hey, are we running short on time? You got your dividend class coming up, right?
I do. It's in 15 minutes, and that will also, yes. So yeah, we're good. And yeah, that's great. I want everybody to get involved in this because, you know, it all goes together. And it's just like all of you traders have all said, you know, like, yeah, you find what works for you, for your lifestyle, what you want to do. There are a lot of different things out there that you can do, but I find that I'll tell you what, everybody listening, I get something from everybody that comes here on Ask the Pros. That's no joke at all. And everything, even though my style of trading is still my style of trading, I learn and I apply all of this. It's fantastic. And I would not pass up Jack's class for anything. So I want to encourage everybody to get involved in that. But
it's going to be great. Yeah, I got something to show you too. Monday that it's my secret weapon. You'll love it. I can't wait to do it. I love doing live classes, and this is going to be an awesome one.
Secret weapon. Oh, I like that. I'm getting in just for the secret weapon.
Get in while you can.
It is really cool. It is really cool. Well, everybody, thanks for joining us today. And I hope your December has been fantastic. I hope your November was fantastic. I hope you were able to ride that all up. And just as Guy said, hey, you know, no fear of missing out, and no, you know, oh shoot, you know, you learn the tactics and the ways to look at the markets. And you got 3 very diverse ways today at looking at the markets, very successful using all of those. It's all helpful, right? I mean, no matter what you trade. So anyway, Jack,
I learn a lot from these guys every time I'm on. I really do. I love the other guys you always bring on.
Exactly. So do I. I'm like taking notes too. And I'm really glad when sometimes when people ask a question, I'm like, oh, I'm so glad that person asked that question because I want to know the answer too. So anyway, well, everybody, thanks. Thanks, Scott. Thanks, Jack. Thanks, Guy. Looks, Guy, like you're back in your office again. I'm glad you got back through all that traffic, and we'll have to have you back, Guy, when and go through some of these. Maybe after the first of the year, that will be perfect timing to hear back from you again, Guy, from across the pond. So anyway, so Jack's class, it's 11 o'clock on Monday. And hey, join me in just a few minutes. I'm going to be live with Garrett Baldwin, that amazing economist. So join me there in about 10 minutes. All right. Thanks, Scott. Thanks, Jack. Thanks, Guy. Thanks, everybody. All right. See y'all later.
See you soon.